Thank you very much. We had a very good discussion in the previous session on climate change and capital markets, the interaction. Now is the right time to we have another discussion which is very important, and this has to do the interaction between climate change, the fiscal and microeconomy. We have two distinguished speakers, unfortunately, because of a variety of last-minute issues, cannot join us in person. John Newton, Chief Economist at U.S. Senate Committee on Agriculture, Nutrition, and Forestry, and Mark Zandi, our next-door neighbor, Chief Economist, Moody's Analytics. They join us virtually. And I will ask, first of all, John, to give us some perspective about the issues related to food, water, environment, and commodities, broadly speaking, as they're related to climate change. And then after that, Mark is going to talk about microeconomic implications. We will have those presentations, and then at the end, we will have Q&A. If it is okay with you, both of you speakers, all right? All right, thank you. John, go ahead.
Thanks so much. Can you hear me okay?
Yes.
All right, let me share my screen. And how is that?
We can see your screen, John.
Yeah, we can see.
All right, great. I'm sorry for not being able to be there with you guys. Unfortunately, I had to send my Washington Commanders to Philadelphia last night, and my wife is from Philadelphia, so we had originally planned to come up and spend the weekend and go to Tony Luke's and get a cheesesteak, but we had a hearing. We had a hearing this morning on rural development issues, which meant I had to be here, for our session week. This week. And what I thought I would do just for this group is just give an overview on federal policy issues as it relates to climate and conservation, because I don't think a lot of people really understand, especially on the food and agriculture side, how much the federal government helps landowners adopt conservation practices, how many resources we provide every single year, the resources that were just recently provided in the Inflation Reduction Act, again, to help landowners address climate conservation issues, sequester carbon. These are things that, outside of food and agriculture, I don't think a lot of people understand, how committed the United States government is, and Congress is, to providing farmers, ranchers, and landowners with the financial resources and technical assistance that they need to continue to adopt conservation practices. And of course, everyone in the audience knows when you deal with agriculture, when you deal with food production, Mother Nature is our business partner. I think that's probably one of the only sector of the economy. Maybe Mark can correct me from Moody's, but I can't think of another sector of the economy where Mother Nature is the business partner. Everything a farmer does after they sow a crop in the spring depends on the temperature that Mother Nature provides, how many growing degree days do they have, the amount of water that the plant gets in the soil. Same thing for livestock, animal productivity, deals with, the amount of forage growth. And as you can see here, I pulled down all the billion-dollar climate disaster events that we've seen going back to 1980. You can see that in recent years, we've seen more and more billion-dollar climate disasters, whether it's additional tropical storms. Tropical storms, by the way, represent about 60% of the $1.5 trillion in disasters that we've seen over the last 40 years. Wildfires impacts food and agricultural production, especially in the California, which is the nation's leading state in terms of food and agricultural production. Drought impacts livestock significantly. So farmers have been dealing with Mother Nature for quite some time as their business partner. So adopting practices and to help better protect the soil, help prevent soil erosion, help protect the water, and conserve the natural resources is critical for the farmer's success and the success in food production. And as you can see across the country, this shows the frequency of natural disaster declarations by the USDA. The darker red the area, the more frequent we see natural disasters occurring in these areas. So again, out west, exposure to droughts and wildfires is very significant. In the Gulf and along the southeast, exposure to tropical storms and severe storms is very significant. And so we're consistently dealing with these natural disaster events and their impact on food production. As a matter of fact, in Congress, the last 3 appropriation packages that we've done have provided some sort of ad hoc disaster assistance for food production. So we saw in 2019 a significant amount of flooding along the Mississippi River that prevented growers from planting a crop. So there was some ad hoc disaster assistance there. We had a derecho a couple years ago in parts of Iowa that devastated crop production. So we had disaster assistance there. And it's expected that we could see disaster assistance yet this Congress in the lame duck session, especially for parts of Florida that were so devastated by the recent hurricanes. Right now, we're experiencing one of the worst droughts that we've seen in the country going back to 2012. That was the last major drought event that significantly disrupted food production. It led to higher food prices, contributed to food price inflation, and we're seeing very similar drought conditions emerge, and they're actually starting to spread east up in the Ohio Valley region, and that has significant implications on a variety of issues. Livestock producers having to move animals off pasture more quickly. It impacts the ability to move product up and down the Mississippi River. You all have probably heard that the Mississippi River water levels were historically low. In early October, the gauge height at the Mississippi River was negative 10.7 feet. That it's hard to imagine how you can have a negative water level, but what that means, it's nearly 11 feet below the agreed upon benchmark water level for the Mississippi River. So barge traffic is significantly reduced. The amount of barges that can be tied together and moved up and down the Mississippi is cut in half. The ability to move crops out of the heartland to the export market is significantly hindered. A lot of the crops, rice, corn, soybeans, grown along the Mississippi and into the heartland, travel out of that port in New Orleans. And with low water levels, you're unable to get the product out of port. That's impacting economies in rural America, and you're unable to get the fertilizers up the river. And so as farmers prepare for fall fertilizer applications or moving into the spring, the need for fertilizers, those prices are going to be elevated because of supply constraints due to low water levels. And these are just examples of how weather events impact food and agriculture production and ultimately food and agriculture policy, food policy that we do here on Capitol Hill. The main resource that agricultural producers have in the event of a climate event or a natural disaster is federal crop insurance. The federal crop insurance program is a public-private partnership with insurance companies. They sell policies to farmers in the event of a crop loss, a revenue decline, a substantial yield decline, and the federal government comes in and helps pay a portion of that insurance premium. The federal crop insurance has been incredibly successful in helping producers financially respond to natural disasters. When they lose a crop, crop insurance is often able to indemnify that grower within 30 to 60 days. So it provides that financial stability to rural America. I don't think a lot of people understand how much it actually costs to raise a crop. A typical cotton combine, for example, is close to $1 million. To harvest corn or soybeans, many farmers are taking out, operating loans in the hundreds of thousands of dollars, every single spring to put a crop in the ground or care for livestock. And again, with Mother Nature as your business partner, you don't know what you're going to have after the growing season concludes. So that's one of the main reasons that we have the federal crop insurance program. And what we also have is the conservation title of the Farm Bill. The Farm Bill is a 5-year piece of legislation that we do here on Capitol Hill. It includes income support programs for farmers. It includes conservation programs, and it also includes the Supplemental Nutrition Assistance Program, the SNAP program, which is $1 trillion social program to help low-income individuals get access to food. So we reauthorize that legislation every 5 years. The current Farm Bill is set to expire in September of 2023. But what a lot of people don't understand is $6 billion a year out of that Farm Bill goes to help farmers adopt conservation practices, landowners adopt conservation practices on the farm. There's financial and technical assistance. They can meet with agronomists to learn how to implement different soil practices, different irrigation practices. And again, we spend $6 billion a year helping landowners adopt those conservation practices. The Inflation Reduction Act included an additional $18.5 billion for more conservation practices, greenhouse gas mitigating activities. Think methane digesters, for example, on dairy farms. So that money is going out through traditional Farm Bill programs. Again, close to $2 billion per year over 10 years in additional resources to address and help agricultural producers and landowners adopt new conservation practices. And it all ties into the administration's goal under the Paris Climate Accord to reduce greenhouse gas emissions by 2050. Agriculture has done a very good job of reducing their greenhouse gas or carbon footprint over the years. As a matter of fact, the most recent data from EPA shows that food and ag production represents about 10% of US greenhouse gas emissions. On the livestock side, beef, milk, and pork production represent less than 4% of total US emissions. And I think you wouldn't realize that based on how often you hear terms like meatless Mondays as the solution to climate change. Agriculture has done a tremendous job. Food companies have done a tremendous job on their sustainability commitments and reducing their greenhouse gas emissions. I think it's important to acknowledge that on the soil health side, and again, I have a lot of material here, and you all will get this material in your packet, so I'm not going to go through every single detail, but no-till conservation practice is the #1 soil health practice that's utilized by farmers across the country. Cover crops are widely used by farmers across the country. Conservation easement, all of these conservation practices are widely used to protect soil health in crop production. There are also very successful efforts in the private sector to increase conservation measures. You see here the number of anaerobic digesters that are operating on US livestock operations really accelerated in 2006 through 2012. The Inflation Reduction Act does provide additional resources to help leverage these public-private partnerships, and especially some of the private dollars to help accelerate the deployment of technologies to help greenhouse gas mitigation efforts. But you can see the private market is certainly helping to drive those investments and drive those deployments of technologies in the ag sector. One of the challenges with greenhouse gas emissions and carbon sequestration, however, is verifying and measuring how much carbon is actually sequestered in the soil, how much emissions are we actually reducing with these various practices. I think there are several carbon markets that are trying to get set up to put a price on carbon, provide the ability to make transactions in the carbon space. But a key to those markets and a key to their successful operation and deployment is the ability to measure and accurately measure the carbon sequestration efforts that have occurred. And I think a lot of people will use a model-based approach to estimate the amount of carbon that's in the soil. Some folks will test soil samples to determine how much carbon is in the soil, but those are highly variable, highly uncertain. You need to take a lot of samples out of soil to get an accurate measure of how much carbon has been sequestered in the soil. Another challenge on the climate and conservation space is how do you recognize early adopters of these conservation practices? Looks like my slides have disappeared. Is that right?
Yeah.
Oh, I'll keep going. I'll just provide audio remarks. How do we recognize the early adopters? Folks that, many years ago started with no-till or farmers that adopted cover crops. They've sequestered carbon in the soil, and many of these new carbon programs, carbon trading platforms that are being rolled out want you to adopt additional conservation practices. So how do we recognize early adopters? How do you make sure that if you roll out a carbon trading program or platform, that you don't incentivize producers to go out there and tear the ground up, release that carbon so that they could recapture the carbon in the soil through the use of cover crops or no-till. I lost my slides. I was still looking at my slides. Let me see if I can get these to come back up one more time. How's that? There we go.
Yeah.
Okay. So I talked a little bit about additionality and how do we make sure early adopters aren't left behind with the continued rollout of carbon trading platforms and climate initiatives. The other thing we have to recognize is how productive we've been in terms of food production over the last 30, 40, 50 years, technology, deployment, crop protection tools to help guard against pests or weeds, improving animal productivity or feed efficiency. We've had a lot of technological advancements in food production that have helped us increase our productivity by 3 times while keeping our inputs relatively fixed. So we're producing 3 times as much food as we did 50 years ago with the same amount of inputs. And that helps us achieve sustainability goals, because without these technological advancements, you would need more land, more livestock to produce the same amount of food that we're producing today. As a matter of fact, to produce the same amount of corn in the United States that we produce today, 30 years ago, you probably need 30 or 40 million additional acres, just because the yields have grown so tremendously through the adoption of biotechnology in crop production. And just as an example of that, you can see this shows the productivity of the United States relative to other countries around the world in terms of corn production. For example, it takes nearly 3 acres in Mexico to do what we do on 1 acre. Brazil, 2 acres to do what we do on 1 acre. China, nearly 2. India, more than 3 acres. So we're incredibly productive. And that's why our conservation programs and our investments from the federal government here in the United States, a lot of them focus on working lands programs and not necessarily land retirement programs, because we do need access to as much arable land as possible to feed the growing population. Idling productive cropland here in the United States will only drive those acres elsewhere, and those producers will not produce it as sustainably or as efficiently or as productive as we will here. So that's just a general overview of kind of the role of climate and conservation in the food policy conversation. I look forward to hearing Mark's remarks, but I'll acknowledge all of the federal intervention that I talked about here still represents only about 2% of federal spending each year. And the key to making all of this successful for everyone in the room, because a lot of folks look at ag as one of the areas that we're going to achieve some of these greenhouse gas emissions targets or sequester carbon, it has to be economically sustainable for the producer. So if there's not a willingness to pay in the market for a product that has a climate smart label, for example, if consumers are not willing to pay more, that cost ultimately gets passed down to the producer. And historically, agricultural producers, their rate of return is only about 2% higher than the 10-year treasury yield. So there's not a lot of money in agriculture. They have very, very tight margins. So to ask producers to adopt additional practices without a willingness to pay from the consumer or downstream supply chain partners does make it incredibly difficult. So economic sustainability definitely is a priority. So with that, I will wrap up. Look forward to hearing Mark's remarks and any questions that folks may have in the audience.
Thank you very much. Mark, I don't know if you can, let's see.
Hi, George. Can you hear me?
Yes. All right.
Fantastic. It's good to be with you all. Sorry I can't be there with you. Thank you, George, for the opportunity, and Drexel for the opportunity. I am a Philly boy. I did watch the game last night. I was not very happy with the refs, I'll have to say. But it was an enjoyable game. But it's good to be with you. And George asked me to talk about and present some work that we've been doing at Moody's around trying to estimate the macroeconomic consequences of climate change. And as you can imagine, this is very much a work in progress. A lot of efforts being put into this. The motivation, lots of different reasons why, but the proximate cause for the work we're doing is the interest in trying to assess climate risk in the global financial system. And I'll have to say overseas, particularly in Europe, but also in parts of Asia, central banks, regulators have been already working hard to get their banking systems and financial systems more broadly to get a better sense of what the risks are to the system. And that's now coming here to the US. The Federal Reserve is now very actively engaged, along with other regulators from the FDIC, OCC, FHFA, to try to figure out, how exposed the system is to climate risk going forward. The Fed has recently asked the 6 largest banks in the nation to begin to engage in some form of climate risk stress testing. So the point is that we are involved in this process, working hard to help financial institutions do this work in a timely and efficient way. I have written a white paper, along with 2 of my colleagues. We published it today, so it's available. You can find it online. It's called "The Macroeconomic Cost of Climate Inaction" with Bernard Yaros and Chris Lefakis. And I highly recommend the paper. It will be much more articulate than I am in explaining what we did, how we did it, and the results that we came up with. So please feel free to Google that, find it, and read it. It'll make what I'm saying here a lot clearer. The exercise that we engaged in for this paper was to consider 4 different scenarios, and the impact on carbon emissions under those 4 different scenarios is what I'm showing you here over a long period of time, from 2020 all the way through to 2100. So 80 years of forecast. So obviously a lot of risk around that forecast when you go out that far. But just to quickly summarize, and I'll describe these scenarios in a little bit more detail, talk about some of the underlying assumptions we made to assess their macroeconomic consequences, and then describe what those consequences are, and then end with a few basic conclusions. The first scenario shown by the blue line, again, this is carbon emissions, CO2 emissions over the next 80 years, is if we lawmakers make no effort to address climate risk. And what we did here is we assume no Inflation Reduction Act. So the Inflation Reduction Act was just the hypothetical, not passed into law like it was a couple months ago. And moreover, globally, there is no additional effort to on top of what's already been implemented. So Europe has a carbon tax, and there's been some efforts in other parts of the world, still quite modest in the grand scheme of things, but we're assuming nothing additional on top of that. You can see CO2 emissions do come down over the period. There will be technological improvements and continued adoption of clean energy. So we do see emissions decline as a result, but they remain elevated to the point that by 2100, global temperatures are about 3.2 degrees Celsius above their pre-industrial average. So that's pretty hot. If that's the scenario, then there's a lot of climate change that will occur. And I will say under all of these scenarios, we consider three types of economic costs. The first is acute physical risk. So we account for the damage created by hurricanes and flooding and fires, and John mentioned Mississippi being impacted, those kinds of things. Chronic physical risk, and that would include a sea level rise, that would include heat stress, those kinds of things. They play out over longer periods of time, and they affect the economy in different ways. It obviously affects different industries. Agriculture is a great example of that. Agriculture is, as John admirably showed, is being significantly impacted. Tourism clearly impacted. Construction, manufacturing, all kinds of activities affected by that. Global migration patterns also significantly impacted, and underlying productivity growth. There's a lot of mounting micro evidence showing that heat stress really does have a significant impact on the productivity of the workforce. So we try to account for all of the fallout, economic fallout from chronic physical risk. And then, of course, so-called transition risk, and that there's no transition risk in the no policy action scenario, because that transition risk is related to the costs involved in helping your economy transition through policy changes. But we do account for those transition costs in the context of the other scenarios that are considered. And as you can see, we do consider a scenario where now we have the Inflation Reduction Act, and the assumption is nothing else happens after the Inflation Reduction Act. That's the end of the story. And you can see immediately a couple things. One, the Inflation Reduction Act actually does move the dial on CO2 emissions. They are meaningfully lower than if there's no action whatsoever, which is, I think an important message that, the Inflation Reduction Act costs the government over a 10-year period somewhere between $350, $400 billion. For context, the economy is $25 trillion. The American Rescue Plan was $1.9 trillion. The CARES Act, which was passed at the start of the pandemic, was close to $2 trillion. The tax cut plan passed under President Trump, the so-called TCJA, that was close to $2 trillion. So in the grand scheme of things, pretty small, but moved the dial here pretty meaningfully. But nonetheless, out in 2100, global temperatures are about 2.8 degrees Celsius higher than they would pre-industrial, and that is still very, very hot, with lots of climate risk associated with that. And then we ran two other scenarios around carbon, different types of carbon tax. The orange line represents kind of a slow phase in of the carbon tax. We assume a tax of $40 per metric ton beginning in 2023, and we increase that over time at a rate equal to the rate of inflation plus 5 percentage points. So, 5% real increase in the level of the carbon tax over time. And it ultimately caps out when it gets to the carbon tax under the final scenario that we considered, the scenario where we get to net zero on carbon emissions by 2050, kind of consistent with the Paris Climate Accords, roughly so. And you can see that under both those carbon tax scenarios, we do get to a place that is more manageable, close to 1.8, 1.9 degrees Celsius above pre-industrial levels. That's higher than the Paris Accord target of 1.5 degrees Celsius, but within spitting distance, and obviously, a lot of risk around these forecasts out at that far. But that kind of gives you context for the scenarios that we considered and trying to understand the macro consequences of those. There's other, obviously a lot of other different policy steps that can be taken to address climate risk. We are trying to evaluate all of those in terms of their macroeconomic consequence, but they require a lot more work in terms of modeling. The carbon tax is the most straightforward. And I will say, not only the carbon tax is a beautiful thing in the context of it's easier to model, but it, in my mind, is the single most efficient way to address climate risk. Just attach a price to carbon, good things will happen. People will respond, businesses will respond, and that's the most graceful way of addressing climate risk over time. But we'll walk through that in a little bit more detail as we go forward here. Just to flesh out the underlying scenarios under the Inflation Reduction Act, just to provide a little bit more context. This shows the impact on the government's budget deficit from, just to give you a sense of magnitude over time, of the IRA, beginning in this year and extending over the 10-year budget horizon through the end of 2031. You can see that it steps up here over the next 5 years, peaks out in mid-decade at around 18 basis points, 0.18 percentage points of GDP. About 3/4 of the IRA is related to tax credits, things to try to incent the quicker adoption of clean energy technologies and conservation measures, those kinds of things. So it's kind of a carrot to try to change behavior. Different than other policies that are more stick-based. Trying to like a carbon tax would be kind of a stick-based approach. This is more of a carrot-based approach, which I think maybe not the most efficient way of doing it. As I said, I think carbon tax is much more efficient, but nonetheless, it is politically viable and got across the finish line. Wasn't easy to do. This is the first major piece of legislation around climate that we've been able to pass, so it was quite an achievement. But I think to make it politically palatable, we needed to do it with carrots and not sticks. The other quarter of it was related to just straight up appropriations, cash, spending, conservation, money to the agricultural sector to try to help move the dial on CO2 emissions. And you can see it sort of phase out over time. You will note there are some pay-fors. They're very minor, small in the first 10 years. If I showed this chart out another 10, 20 years, though, the spending goes away, but the tax cuts remain and they become more significant. And by the end of a 20-year period, the IRA is more than paid for, substantially paid for. So it's not paid for over the 10-year budget horizon, but it is paid for and then some over the 20-year budget horizon. The two carbon tax scenarios, just to flesh out what I said earlier, just to give you context visually, this shows the actual tax, dollars per metric ton of emissions. The blue line represents that carbon tax scenario where we phase in the tax slowly over time, begin at $40 per metric ton and phase that in, inflation plus 5% every year. And then the green line, we had to calculate that. We had to determine what carbon tax was necessary to get emissions down sufficiently that we were at net zero by 2050. And you can see by 2050, the carbon tax amounts to about $2,400 per metric ton, considerably more than that phase in. So it's a much more draconian, dramatic kind of effort to bring in emissions through a carbon tax. And as I mentioned earlier, under the phase-in carbon tax, we cap it out at the net zero carbon tax when it reaches that level. So you can see it they're equal as you move out into the outer years of the forecast horizon. Okay, to generate these scenarios, we had to make assumptions, and like all forecasting anything, you have to make a lot of assumptions. And we made a boatload of assumptions here, but let me talk about a few of them. The first is that, here we're focused on the US. We made the assumption that the rest of the world adopts policies that reduce CO2 emissions in their countries at the same rate that they're reduced here in the United States. We're agnostic with regard to how they did that. Could be through a carbon tax, cap and trade, all kinds of different ways of doing that. But we're agnostic to that, but we're making the assumption that the UK and Canada and Japan and South Africa and Australia, everybody is doing roughly the same thing here. If that's not the case, if they're moving more quickly like they are in Europe than the US, or they're moving more slowly like they are in much of the emerging world, then we get there's a different story is going to result here, but we're making that working assumption. The second working assumption is that the federal government does help to defray the costs to the private sector of acute physical risk, and that is motivated here. This shows you the cost of natural disasters that are climate related, mostly climate related. There's some earthquakes in here as well, but mostly climate related, going back into the late 1980s. This is all in billions of current dollars, 2022 dollars, and we break down the economic loss in terms of the destruction, the physical destruction that occurs, and the lost economic output due to the disruptions to the economy. The economy shuts down for a time because of the physical disruption, and the result is the total loss. And then we determine what kind of aid comes into the economy, from insurance money to government aid, and that includes mostly federal government aid, but there's also aid that comes in from other sources, NGOs, and you can see about on average, about half of the total economic loss is covered by the government in one form or another. And we make the assumption that going forward, as we have more economic loss due to physical risk, that we maintain that ratio, that the federal government, the state, local government will ante up and provide support that's equal to about half the economic loss. Third assumption is that there's a border adjustment mechanism, that if we have a carbon tax and others don't, then it would put our industries at a disadvantage that are dependent on that energy. And so we have a tax credit tax system on exports and imports that equilibrate the cost, so that our industry is left whole with regard to its competition with regard to other countries. Otherwise, if we didn't do that, very unlikely that kind of carbon tax policy would ever get through the legislative process into law. And then finally, the final assumption I want to call out is that about 60% of the revenue that's generated from the carbon tax is redistributed back to households in the form of a dividend payment. And that dividend payment is the same for all households. So whether you're making $60,000 a year or $600,000 a year, you get the same size check. And that helps to defray the cost of the carbon tax on real incomes and purchasing power, but it also helps with the regressivity of something like carbon tax, which would likely hit the finances of lower income households harder than the finances of higher income households, just because of their, the things that they're spending their money on. The energy consumption as share of the consumer basket is much higher for people that are in the bottom third of the income distribution than in the top third of the income distribution. I can go on. There's lots of assumptions. And I said there's a lot of gory detail in that paper, but those are some of the key assumptions that we're making here. And they're consistent with, some of the proposals that are out there. The Climate Leadership Council, for example, has been espousing a carbon tax similar to what we have we're modeling here. One point about methodology, and then I'll talk about the results and then stop. We did have to do a lot of work on our global model. We have a model of the global economy, well over 100 countries around the world that capture, it's a structural model. I won't go into a lot of detail. Very similar to what the Federal Reserve Board will use when trying to do its forecasting to set monetary policy. Congressional Budget Office uses it for doing the budget of the U.S. It's kind of the workhorse kind of model that people have been using for all the stress testing, climate risk stress testing that's being done in Europe. At this point, most of it's being done with these so-called structural models. This is a large-scale structural model. Just as a point of interest, a lot of that goes all the way back to Larry Klein, who was my thesis advisor at Penn. He was the founder of kind of practical econometrics and this kind of modeling, and it all goes back to his work back in the 1950s and 1960s. But what we've done is we've taken this structural model and we've added a climate risk component or module that allows us to capture the effect of different first energy demand across fuel type, then determine what carbon emissions are based on those fuel types, and then bring in carbon taxes and see what the effects are on on energy demand by fuel type and emissions, and ultimately what those emissions mean for temperature, and then what those temperature changes mean for different aspects of the economy that I described earlier. So there's a lot of work going on. We've not been able to model all 100 countries. We've modeled over 20, closing in on 25 countries. We have this now expanded model with the a climate risk module that allows us to do these kinds of simulations and these forecasts. The other thing I'll mention is, this is a sidebar for anyone who does modeling and forecasting, taking anything out to 2100 is pretty hard to do. Even if you're not accounting for climate risk, a lot of demographic issues and assumptions that have to be made. So again, a work in progress. So let me end, because I'm taking my fair share of time, on the bottom line in the results. And this, I think, helps you get your mind around the impact. This shows the change in U.S. real GDP between each of these four policy scenarios in a kind of let's call it a reference scenario to be consistent with kind of the NGFS scenarios, the network for the greening of the financial system, which has kind of become the benchmark for a lot of this scenario work. So this is a no climate change. Just for whatever reason, climate change doesn't occur, and we have no acute or chronic physical risks that result. And let's compare GDP in that scenario, no climate change, with GDP in each of the scenarios that I've described. And immediately you can see under the no policy action scenario, it has the least impact on the economy in the near term because there's no transition risk. The banks don't need to adjust because of policy changes. But obviously, as you get further out into the forecast horizon, and certainly by 2100, it's a big deal. The temperature rise is so significant, the physical risk so large that the hit to GDP is almost 9%. That's a big deal. GDP, the U.S. GDP is 9% smaller than it would have been otherwise, if we had taken no policy action. And just to bookend things is the carbon tax scenario. That's the slow phase-in, $40 in 2023, phase-in inflation plus 5 percentage points over time, capping out at the net zero carbon tax in the out years of the forecast. And you can see, that does have economic costs in the near term. It's a tax and you got to pay it. And it does have impacts on inflation and on real incomes and on profitability and the government's fiscal situation and so forth and so on. But by 2100, the economic loss is much more manageable. It's about half the size. The economic damage to GDP is about half as much as it was in the no policy action scenario. And then finally, just breaking down that forecast a little bit more, going out to the year 2100 and looking at the impact on GDP under the different scenarios and decomposing that into the different components related to acute physical risk, that's the blue part of the bar, chronic physical risk. That's the green part of the bar. So in the no policy action scenario, you can see there's no transition risk. Therefore, it's all, physical risk, acute or chronic. And then if you got to the net zero carbon tax, it's, much less physical risk, it's mostly transition risk, adjusting to that very large impact. But this kind of gives you a sense of the impact on GDP and where it's coming from in terms of the physical and transition risks that are involved. Okay, with that, I covered a boatload of ground. Hopefully that was somewhat helpful, and I'll stop and turn the conversation back to you, George.
Well, thank you very much. We appreciate your both of your presentations. And are there any questions from the audience? That yes, please. Go ahead. Hold on for a second. You have a microphone here?
For America's significant agricultural productivity.
This is a question for John, I think.
Hello, I'm Sydney Zilkow. I'm a senior studying finance at Drexel. I was wondering, are GMOs and other looser food safety policies a factor for America's significant agricultural productivity?
Can you hear me?
Yeah.
Okay, so the question is, are GMOs an important contributor to agricultural productivity? Is that?
Yes, regarding the land productivity.
Without a doubt. I mean, the science-based approaches to food production, I think, is very important. Biotechnology to allow crops to be resistant to certain pests, be resistant to weeds, helps improve crop productivity. Be heat tolerant is another element, and you can, through gene editing, cure diseases in crops, and that could be very beneficial in developing countries. So I think there's a growing sense that we need to accelerate the adoption of biotechnology, accelerate the acceptance of science-based practices in food production, if we're going to meet the food security goals and demands, quite frankly, of the world. We have 8 billion, the population hit 8 billion. If we're going to feed those people, we need to accept science-based policies and science-based food production.
Thank you.
Gabriel, is it for John or yeah? Question from Gabriel.
I just want to say, I think Mark's was better. He should get all the questions.
No, thank you, John. Just a definitional question. We're working on sustainable fisheries and financial products right now for consultancy. Is fisheries within your committee or not? And if it's not, would fisheries would it benefit for fisheries to be within your committee, because they're obviously a protein producer, and you have a lot of, obviously your committee's focused on agriculture and nutrition, which could be argued that fisheries should be within the committee. Thank you.
So I'm going to, not to make light of the question, but I think there was, and today, on the day that Trump is probably going to announce that he's running for president again, he was famously quoted as saying, there are so many government agencies that regulate salmon, for example. I think like the Interior Department, USDA, FDA. So aquaculture is kind of tricky. We do have some jurisdiction over aquaculture. When you think about, there are crop protection or crop insurance products for oysters, for example, that are being developed that we have jurisdiction over. Nutrition assistance programs and the presence of seafood products, would be something that we have jurisdiction over. But there are other government agencies that have jurisdiction over aquaculture. It's unique among the sectors of the economy that have so many agencies that oversee them.
Any other questions for John before we move to Mark? Any questions for Mark? Mark, I have a question. Based on your research, you saw regardless of the type of climate change initiatives, we're going to have a negative GDP in the coming years. And all you do, you compare the GDP that we would have had we not had climate change initiatives versus to something that we can intervene. Is this accurate? That is, in your model that you project in the coming years, we would have, because of climate change, we're going to have, no matter what, some change in the GDP, negative change.
Yeah, that's right, George. I think, if we don't act, if there's no policy to address climate change, the physical costs are going to be significant. I think that's pretty clear. And if we respond through whatever policy change we adopt, from a carbon tax to cap and trade and everything in between, it's a cost. It creates an adjustment cost. And so, yeah, I don't think there's any way to avoid that. I will say, though, that, take the carbon tax, the graceful, slow phase-in carbon tax scenario that I described. GDP is down 4 percentage points in 2100. That's 80 years from now. We're talking basis points per annum, right? So
Okay,
we're not talking percentage points per annum.
all right.
We're talking basis points. And that, I'm the one thing I'm not accounting for, this could turn out much better than anticipated, is technological change. Things can change very dramatically, and I'm not able to account for that because I just don't know. I can wave my hand. A lot of this is waving my hand anyway, but that's a higher level of hand waving. And so, it could be that we end up in a better place because of the technologies that come out of this, this
Productivity of
challenge.
capital,
Yeah.
or other things, yes.
Yeah.
Yes, of course. I mean, you have made several assumptions, and of course, because you have long dated model, those assumptions might be not valid or might be further refined as you move forward with your macro model. And this is macro model that you use on the global scale, I presume.
That's right. Yeah, there's a lot of things. This is very macro. It's very, if not 30,000 foot, 10,000 foot. And there's a lot of things going on underneath that, that are too nuanced for us to capture. Certainly at this point in our modeling, in our work, it's improving, very quickly, and data is improving, very quickly. And there's just a lot more to work with than we had before. So, for example, one of the really important questions that is key to economic loss is pricing risk and pricing the climate risk. And that varies considerably across the country, place to place. Florida has a different level of risk than Des Moines, Iowa, has the level of risk. And if you can account for that, measure it, price it, meaning in terms of lending rates, insurance rates, the cost of doing business, that could lead to a much more efficient, response to all of this. So the data is getting better, and the modeling is therefore getting better, and our analysis is getting more refined. But to your point, we got a long ways to go before we're in a place that we can feel comfortable with kind of the results we're getting, at least at a more granular level.
Right. And thank you, Mark. But I guess the message is very simple: that it's under certain circumstances and assumptions, inaction is costly. This is
I mean, bottom line, 3 points. One, we can move the dial on climate change in a meaningful way at relatively low cost if we move quickly now. Secondly, if we don't do anything, that's the worst outcome. It's going to be a big deal, and we're probably underestimating how big a deal it is. And three, it's not that difficult a problem, in my view. I mean, the reason why I am reasonably sanguine about this is there's a solution, a pretty straightforward solution, in my view. Just tax carbon. You tax it, raise the price on it, then good things will happen. The beauty of the American economy is we respond very quickly to incentives, to prices. You know, look at the energy, look at the fossil fuel industry, right? We go back 15 years ago, we thought we were zero oil. We was going to run out of oil. You know, back in before the financial crisis, oil hit 140, 150 bucks a barrel in those dollars, those years. And we thought we're running out of oil, but those higher prices incented fracking, and fracking has significantly changed the outlook for energy use. Now, we should do the same thing here. We should raise the price on fossil fuel, and that'll cause us to go out and figure out ways to conserve on it, use less of it, and bring those emissions down. So I think there's a pretty straightforward approach to getting this done. It's just we don't have the political will to do it. But my sense is at some point we will, you know, when it becomes patently obvious that if we don't, the cost will be meaningfully greater.
Thank you, Mark, and thank you, John. I think there's just one last question, but I can tell you that it was very strategic on my behalf to have both of you at the end of the conference, because you summarized very nicely what all of us, I think, we hear it in other sessions with a couple of additional things. But there is one last question from Sean.
Quick question for Mark. How does the model assume the proceeds from carbon tax are spent? And if those are spent on carbon reducing initiatives, could there be a more optimistic case?
Yeah, we assume that 40% of the revenue goes to the government to help defray the costs of rising physical risk, so to pay for the damage caused by hurricanes and flooding and everything else, and also to help finance some additional efforts to address climate risk. And then 60% goes back to households in the form of a dividend payment that's equal across all households, so that, you know, address the regressivity issue. So, and that's just an assumption. We can the reason I picked that 40-60 is because under that I can keep the debt to GDP ratio for the federal government low enough that it doesn't cause interest rates to rise to such a degree that it creates, I'm optimizing around interest rates, which would affect long-term economic growth. So that 40-60 is kind of the sweet spot in terms of mitigating the economic fallout, because I'm helping households with their real incomes, and I'm limiting the interest rate increases related to the rising fiscal costs that are involved. But so it's an optimization, but it can, that's just an assumption.
Thank you, Mark. And John, I think you would like to conclude with a few remarks.
I had a question for Mark, if I could.
Yeah, go ahead.
Mark, one of the constraints that you indicated in the model is that you assume that every country is on the same trajectory, and we know that's not the case. So have you considered evaluating the model, knowing that, you know, other countries around the world are not going to be on the same pace? You know, there are some competitive advantages that could be created unless you have a carbon adjustment tax. If other countries aren't playing by the same set of rules, especially in a global economy.
Yeah, no, great point, John. I do assume a border adjustment mechanism to equilibrate the price, the fossil fuel price, so that our agricultural sector, our manufacturing sector, or transportation sector aren't disadvantaged compared to other. But you're right. I mean, if on average the rest of the world is slower than we are in mitigating climate risk, or faster than we are, the results are going to be different. And I have not gotten there yet. I've not gotten to that place yet, but that's definitely on the list of things to do going forward.
Very good, thank you both. Thank you very much. I want to say that we had a very productive, informative discussion in the conference.